Guys, it's Latoya here with Elevated Standards, and on this channel, we inspire, encourage, motivate, and as the most recently informed entrepreneurs. And in this video, we're going to talk about the different business structures because we've been having a lot of questions come in about business structures, and it's been a little bit of confusion. So let's talk about it. So our most common business structures are going to be our sole proprietorships, our limited liability companies, partnerships, and corporations. So, a sole proprietorship is a business that you have solely. No other partners are involved in the ownership of this business. And with that, you gain all the assets and you receive all the liability. Typically, you do not have an EIN when you have a sole proprietor. Typically, you would use your social security number. That is not always the case, but that is the case in most situations. So you use your social security number to do business. Your business is you and you are your business. I know as a business owner, it feels that way all the time, regardless of your business structure. But for a sole proprietor, that is the case. You are the business is you. You are liable for anything that happens within your business, and you have no protection of your personal assets. So do know that. So most people go into the most commonly used business structure, which is an LLC, a limited liability company. And you use your LLC for the protection to separate you from your company. When you register your business and you get that paperwork from the state and it says sole member LLC, you are not a sole proprietor because you are separated from your business. You and your business are two different things. It is an entity of its own. For your LLC, you're using an employer identification number. Your personal assets and your personal liability is yours. The business assets and the business liability is the business's. So typically with your LLC, you will make sure that you have a salary. You cannot mix your funds together. That's another thing that I'm seeing people having a lot of concerns and issues with, is that they're commingling their money together. Their personal money and their business money should be separate. Do not combine the two. Now, when you're first starting out, of course, you have expenses and things of that such that you need to start the business with. And so you set aside that money as the foundation, if you will, the startup money that you're using for the business. And you use that money and then you gain more money from the business. And then, like I said, you pay yourself out. Let's talk about partnerships. You have your LPs and your LLPs. When we talk about LPs, we're talking about limited partnerships. So when you have your limited partnerships, you're going to have two types of partners. You're going to have your general partners and you're going to have your limited partnerships. And so when it comes to the general partner, they're the ones who are part of the day-to-day of the business. And they are personally liable. They are obligated to the business. But when it comes to that limited partner, the limited partner does not have involvement in the day-to-day, and they have a limited liability. Why? Because they are not a part of the day-to-day. So let's talk about the LLPs. The LLPs are very similar to the LPs, but your limited liability partnerships, generally speaking, all of the partners have limited liability. It protects them from the actions of their partners. You typically will see LLPs in professional groups such as law offices, accountants, architects. You'll see LLPs. For your LPs, you're going to see more of your family-owned and operated businesses. So let's talk about corporations. Corporations are very different from your sole proprietorships, your LLCs, your LPs, or your LLPs, because a corporation can enter into a contract independently. When we talked about the sole proprietor, we talked about the sole proprietor having all the assets and liability of the company. Well, similarly, the corporation has all the assets and liabilities of the company because the corporation can go into contracts by itself. It has shareholders. It has assets and liabilities that it's responsible for. It's its own entity when it comes to a corporation. So it is different from your sole proprietor because the sole proprietorship is an individual. The corporation is the company. Okay, so in everything in between, the LPs and the LLPs and the LLCs, they are in the middle, because while you have limited liability, it's not all on the individual, it's not all on the company, it is limited. Okay, so there's the difference between the sole proprietorship, the LLCs, the LPs, the LLPs, and the corporations. And typically when it comes to the corporation, you have several different type of corporation types, but typically you have two. You have your C corps and your S corps. And when you come out of your LLC stage, when you're earning all this money, you go into a different tax bracket. So in that regards, you then go into your S corp. That's the next stage up for you. And because the S Corp is the next level up, it helps to avoid double taxation. So what you're going to see in the C Corp is that it's taxed separately from its owners. Typically, what you're going to see in corporations in general is that it has a board of directors. It has more meetings. It has a lot more paperwork involved with corporations than it does in any of the other business structures. Well, guys, I hope this cleared up any confusion that you had about business structures. So if you have any questions, please leave them in the comment section below and we will definitely address them. Okay, so I hope that you found this video informative, and listen, until next time, have a great and amazing rest of your day. Bye now.